All right, everyone. Let's get tonight's meetup started. Welcome everyone to our monthly West Side meetup, real estate related. And for those of you who don't know who I am, my name is Gilbert Coloma. I am a out-of-state investor, working a W-2, looking to increase my passive income through my portfolio, right? And you know, hopefully retire sooner rather than later, one day in the future, right? So, just investing in real estate for now and trying to see where it gets me. For those of you in here, I'm pretty sure we all have the same goals in mind, right? So, um, for the meetup tonight, I'd like to go over some housekeeping rules, right? So first, this meeting will be recorded and posted online. If you wanted to watch it again, if you missed something or want to share with some friends later on, right? Second, I'd like to ask everyone to please mute your mics to minimize distractions for our speaker and for everyone else. All right. Third, if you have any questions, please post them in the chat and we'll answer them during the Q&A portion of the presentation. And lastly, please stick around after the presentation as we transition into breakout rooms to do some networking. As we'll find out, networking is really big in real estate investing. So please stick around for that. And now I'd like to introduce host Brandon Rabe.
Right on. Yeah, thank you, Gil. And for those of you who are unaware, Gil is the new co-host at Westside Meetup. So thank you for stepping up and kind of filling Young's roles. So yeah, glad to have you here with me. All right. So yeah, thank you guys again. And in addition to the housekeeping items, I did want to share a couple more things. If you guys are not already part of the Facebook group and the email list, go ahead and join our group and get onto the email list. That way you get all the up-to-date information of the meetup and other upcoming events that we'll be having. If you don't have the links, I'm going to throw them into the chat right now. In addition to those things, we also have a roster for tonight. If you guys wanted to fill that out, it's just another form of networking with other people that are on the call. You can go ahead and fill that out. We're not going to share that with everybody, only to people who fill out the roster. So yeah, just keep that in mind. Fill that out if you're interested in being a part of that. And then for the email list, send us a short email to that email list, to that email address, sorry. And then that way we can just add you right onto the email list. Okay. So if you guys don't already know, my name is Brandon Rabe. I am an active investor, just like Gil, working towards financial freedom and building a passive income portfolio. I'm also an advisor with WNN Properties and a personal development coach. So tonight we have a very special guest, one that I'm excited to be speaking with, and one that I'm grateful to call a personal friend. He is, his name is CJ Calio, and he's going to be talking about commercial real estate investing. And I know a lot of you guys requested this topic, so we're just thankful that CJ is willing to come on and share about his journey and talk about commercial investing. So the questions that you guys have, please throw them in the chat again, and then we'll go through them during the Q&A portion. Now, let me just share with you a little bit about who CJ is, just in case you aren't aware of who he is. So CJ Calio is a buy and hold investor and out-of-state specialist who focuses on creating portfolios of cash flowing producing properties out of state. He is the proud owner of WNN Properties LLC, a mentorship and consulting company. He and his wife have been able to quit their day jobs and live their dream of being full-time investors while spending more time with their 3 wonderful children. So with that, I'm excited to bring on CJ Calio. Hey, CJ, what's up, man?
Hey, thank you, Brandon, for the introduction, and Gilbert. It's always a pleasure to be here on Westside Meetup. For those of you who don't know, me and my wife actually started this meetup a little over 5, almost 6 years ago now. It was in a group of maybe 3 to 4 people tops back then, and it's grown to be able to support the Zoom community. And it's nice to see a bunch of new faces. Zoom allows us the capability to be able to connect from across different areas of the country. So it's always a pleasure. I look forward to being able to share with you guys. So before I go into the commercial, the topic, I want to go back to where it all started. So I see a lot of new faces on here, and most of you may not know my story. It goes like this. I was a UPS driver. So I was actually Brandon's coworker, right, Brandon? Back in the day, yeah, wearing the Browns. What can Brown do for you? Delivering the packages, playing Santa during Christmas time. That was me. Anyway, local boy raised in Hawaii, got married, had 3 kids, had a really good union job, UPS. It's highly desirable, intense physical labor, good pay, good benefits. The epitome or what I've been raised to do, right, is to take on this type of profession. So I did. And in the beginning, I enjoyed it up until the part where I didn't. And that part came about 7.5 years ago when, for those of you who know UPS, Christmas is our favorite time of year. And I use favorite with sarcasm because we are on the road a lot and we work weekends and Sundays, and we're making sure you get your Amazon orders and gifts in time. Well, that particular Christmas was probably the worst Christmas ever. I believe, Brandon, you still remember that Christmas.
Yep.
We actually made the news that year. That year, we had viral videos of local UPS drivers throwing boxes and out past midnight. Well, yeah, I was one of them. Not throwing the boxes, though. I never did that. I was one of those guys. I was out running 1, 2 in the morning delivering your packages. And something just clicked. This has got to be a different way to do things, a different way to produce a lifestyle where I'm not trading time for money. And that Christmas opened my eyes that as much as I'm banking on my W-2 overtime and all these extra perks we got as drivers working long hours, I was sacrificing a lot of personal time, a lot of time with my wife, a lot of time with my kids. I mean, it's the most joyous time of year to me. Christmas, I really enjoy. However, that Christmas, I didn't see my wife or kids for almost 5 months, and I lived with them. That's how much time away from my household I was. Well, long story short, after that Christmas, understandably so, I was upset and didn't want to work there anymore. And my wife asked me, so what are we going to do about this? You make really good money. We don't want to change our lifestyle. We do have kids we got to feed. What do you want to do? And I had no answer to that. So my question to her is, what can we do? She produced real estate as an option. I was like, great, we're going to invest here in Hawaii. No, that's not what I was talking about. She was meaning investing cash flowing assets, rental properties, but somewhere else, because Hawaii just didn't make sense for our price point and what we're looking to achieve. I was very resistant to it. So long story short, created businesses, tried the route of MLM marketing, startup businesses, car detailing, landscaping, housekeeping, everything to do with what I thought I was skilled and physically capable of doing myself. Basically, the epitome of a self-employed person. And none of those businesses failed. However, my wife decided that while I go and do this, she was going to go and try her idea of what could get us out of our W-2s. And then she went and bought turnkey property. Well, during the year, I was starting and closing businesses, which I did in 1 year, 9. That's pretty common, I guess, for startups. I closed 9. She bought 1 and was rolling into 2 more. I was like, man, obviously what you're doing is working. We didn't get burned. I'm over here stressing, still putting in a lot of hours, still having to work at UPS, not producing any form of financial freedom for my businesses. Why don't I jump on board with her? So I decided to educate myself. I read the Rich Dad Poor Dad, played the game, started listening to podcasts, joining these events, like these networking events, and start to meet like-minded people and come to realize there's a lot of people investing out of Hawaii. So I drank the Kool-Aid. And from that point forward, I learned how to grow our portfolio. And quickly, we ran out of money. I don't know about you guys, but I have a limited amount of capital. And that only allowed me to buy 4 or 5 turnkeys before I realized I don't have any cash left. So how do I continue growing? These $100 per door doesn't get me to replace my UPS income, let alone my wife's income. So we had the opportunity to adjust. We call it pivot. From there, I found the BRRRR strategy. Yeah, I'm sure you guys are familiar with the BRRRR strategy, right? Buy, rehab, rent, refinance, their pockets thing, right? Picked that up, learned that trade, grew our portfolio. In about 3.5, 4 years, we ended up with about 90 rental properties. And we were on the verge of getting out. And it was funny because the whole time we were grinding away, I was grinding away, creating opportunity, building our portfolio. We got to 90 doors and I was celebrating, but I looked at my wife and she was exhausted and tired. I don't do the back office stuff. She does. So the property management, the upkeep, the lease renewals, the dealing with the tenants, termites, and toilets, that's all on her. I am purely acquisitions and creating of additional properties to our portfolio. I looked at her when we were at the 90 and we were just like baffled because she's like, we have the money, but I'm more tired than I ever was because there's so much that goes into managing these 90. And mind you, we have property managers. It's not self-managed from Hawaii out in the Midwest. We had teams, yet she was still feeling burnt out. Well, that's when the light bulb clicked. Like, okay, I can continue on this path, but just create more headache and work for my wife, which is against what our philosophy is. We want freedom. We want more time to do things we love with who we love. She's like, well, what can we do next? And it's funny because about 6 months prior, we were talking with some fellow investors at a networking event. They're like, oh, why don't you go into multifamily or commercial? And we're like, nah, we're really good at residential, really good at single family, and really good at the BRRRR. I'm just knocking these things out and we're growing our portfolio. That's too risky. That's too big. I don't want to play like that. Well, 6 months, fast forward 6 months later, commercial was what we decided to pivot to. So we got this philosophy from Rich Dad. I had the pleasure and opportunity to be able to sit at his feet for 4 hours, maybe about three years ago. So right when I was exiting the rat race, exiting my W-2, I got to sit and talk to Robert. And he basically asked me, why are you spending so much time playing small? See, the thing is, if you've played Rich Dad, Poor Dad's game, cash flow, if not, highly encourage you to play it. Well, there's opportunity in the game. There's small deals and there's big deals. What he was telling me is, CJ, you know you play the game, right? Yep. You understand that there's small and big deals. Yep. Why are you staying in small? Oh, because it's comfortable. You need to get uncomfortable. And it stuck with me. And everybody who knows me knows I reference to that line all the time. Get comfortable being uncomfortable. So that's what I was challenged to do by Robert Kiyosaki himself, the big man, the one that wrote the Purple Book, the game changer for a lot of us. I realized these small deals are comfortable, but the returns are minimal. Now, what do I need to do to get into these big deals? Now, another line he gave, another gem or nugget he shared with us that night was think of Monopoly. Everybody knows a lot more about Monopoly than they do about cash flow. But what do you do in Monopoly? You buy property, right? You get the set and you start adding greenhouses. The greenhouses produce a lot more cash flow than the base rent. But eventually you get to a point where you don't fit any more houses. You have to buy a hotel. That analogy clicked in my head and made me realize I have everything I need through the creation of my portfolio of 90 doors to get started in commercial and be okay. So what I did is I created this thought process, and now I've pundit catapult strategy where I've taken a few of my doors and I've rolled it into a commercial. So I'm not necessarily taking my cash and plugging away in something risky. I took something that I already had, the equity that's built up, the depreciation, the debt paid down that I had from my tenants, and I rolled it into a commercial, which made me feel a lot better because I didn't feel like I was in too much of a risk play in that sense. And I just rolled a lot of what I learned in the residential over. Strangely enough, commercial is really different. Don't get me wrong. And when I mean commercial, I'm not talking commercial multi. I'm specifically in commercial, retail, office, medical, and government buildings. So there's commercial multi, and then there's commercial. I'm in commercial. We rolled it into our first property, and I took the BRRRR analogy and I wanted to carry it over. See, for us, cash flow is our number one thing. The second thing is a value add. So if I can first get cash flow, it's a deal. If I can get cash flow and a value add, it's icing on the cake. If I can get cash flow, value add, and pull out my money, that's cherry on top. And that's what we shot for on our first commercial deal, because we figured, why can't we take this analogy and just compound it, meaning taking that extra zero and adding it to the commercial and play the same thing out, which is what we did. So maybe three years ago, little shortly after my chat session with the big man Robert, I took that leap of faith. We bought our first commercial property. It was a retail space that was on the borderline of being foreclosed on, and we were able to get an opportunity to speak with the bank themselves to restructure something so that they didn't have to foreclose on the owner, and the owner was willing to walk away from the asset without having that reflect on their record. So we came in, we offloaded a couple of properties. We did what we call as a 1031 exchange, rolled the gains into this asset, allowed the bank to create the funds through lines of credit to allow us to rehab it and get this retail space up and performing. Now, a little history on this space. The space is probably about 8,000 square feet. If I recall, there was 11 rentable units in there. At the time, it was underperforming. I think it was 30% occupied and only 25% cash flowing, because the 15% was a rental company that was renting stalls out in the parking lot, but they weren't paying. So we came in there with the same analogy as the Burr, looking to value add. The funny thing is, I had to change my mindset, because in commercial, when you're value adding, it's not always about the hammer and the nail. It's not always about taking ugly and making it pretty. In commercial, what I found, and this is through my experience and what I see often, is the value adds in the repositioning of the asset. And in this case, it was simply just getting it performing. So the owners of the building occupied 60% of the space. So in theory, when it was owner occupant, it was roughly about 90% occupied. That's pretty good performing in a commercial space. We like to run our numbers between 80 and 90% is a pretty stable commercial performing asset. Oh, they're no longer there. So 60% of the space is now vacant. It is underperforming drastically. We came in, brought in our teams from our networking that we were cultivating relationships with when we were ready to take that leap. And we started to fill the spaces. Well, about a year and 5 or 6 months in, we got it from 30 to about 75, 80% occupied. And we just had a few more spaces vacant. One was a larger space with an office, and another one was just a little studio style room that'd be ideal for maybe a tax person. Well, we were marketing it for rent, and somebody came in and wanted to buy it from us, basically as an owner occupant. This particular buyer wanted to owner occupy the remaining space, and they liked the fact that we got it from 30 to 75% occupied. Well, long story short, that quickly turned into another sell of a property and roll into a larger asset. And it just solidified our capability of taking underperforming commercial, no different we do in residential, but in commercial, putting some sweat equity in through proper team members, knowing the market, how to market for rent, filling the space, knowing how to lower our operating expenses, and raising our revenue, our NOI, net operating income, to reassess the asset and make it worth more. And long story short, this person bought it. They bought it way above what we paid for it. Plus, during that whole time frame, we were cash flowing. We were able to roll that into a larger commercial, and we're continuing that catapult strategy as we speak. That was our first big deal. Since then, we've accumulated 8 more commercial buildings, and there's a few of them behind me. If you can see that, kind of weird, but we're loving it. We've been slowly dwindling down our 90 doors, because residential, as much as it was wonderful while we were in that season, we feel and have tasted the returns of commercial, and we are loving it. So that's a little bit of my backstory. I know Brandon wanted to go into a little bit more of a QA session. Did you want to start that now, Brandon?
Yeah, sure, we can do that. I know Chris has a question already in the chat, and he says, sticking to the point of playing big, would you recommend going straight to multifamily properties versus single family properties?
If you're asking for my opinion on this, which it sounds like, I usually advise people to go through the progression of, I mean, if you think of it in everything in life, there's a progression. I think in real estate investing in general, there are progressions as well, and you're going to want to trust the process. And it's more, the speed comes from your willingness and commitment to honing in skills and pushing yourself harder each and every time. What I see when people jump from no real estate investing to large deals is that they make bigger mistakes early that can be more costly than if you're playing on the smaller side. So it's not impossible. I'm not saying you can't do it. I recommend you learn your ropes with a small, get the mistakes out of the way, because we all make it. I've made a ton. I've lost a ton of money. I'm not here to preach that I'm always hitting batting 1,000. I make a lot of mistakes. I still do. Now my mistakes in these commercials are tens of thousands, if not hundreds of thousands of dollars costly, right? Versus a residential, maybe it's $1,000 mistake, a $500 mistake. Worst case scenario, it's a $10,000 mistake in certain situations. But a lot of those things are growing pains that you're going to need to experience at some point. It's not a matter of if, it's a matter of when. And I feel if you do that, you're less inclined to quitting on the process, because it's not easy, right? It's a simple concept. Put your money into real estate, let it produce cash flow for you. And it's definitely not easy. There's a lot of work. There's a lot of effort. There's a lot of ability to learn, opportunities to learn, learning curves that you're going to need to grow through. And I'm still experiencing that, just on a different level. So I would recommend starting small and progressively growing as you get confident in, and being able to repeat the same success consistently. A lot of people jump when they hit that one home run to something larger because they think they can do it because they just hit that one. But if you look at baseball, I love baseball as an analogy, because, Hall of Fame hitters are batting 350. So 35% of the time they're hitting, 65% of the time they're striking out or not making it to base, right? But that's Hall of Fame. That's elite level hitters. Same in real estate. If you can consistently bat something like that, it makes up for the 65% you strike out or don't make it to base. But you got to be able to produce that consistency. And consistency comes from multiple attempts at the same thing over an extended period of time, where you can reflect on your results. Results are your best form of feedback, because if you're not consistently doing something, why? You got to learn to ask yourself the right questions. What am I missing that's causing me from the consistent result that I originally got on the first one? So yeah, start small, progress to big.
Yeah, good stuff. Thank you. Okay. Blaze asks, do you invest in the same areas as your single family homes?
No, I don't. We were in 3 markets at one point, and we focused in all our efforts into a specific market, primarily because we were able to create the team. And if you're out of state investor and you're not there physically, which I love because it forces me to leverage and to network with others, you got to run with the right crew. And if you're running with the wrong people, it's very easy for you to get burned or put into opportunity that you might not be aware of that is beneficial for your ultimate goals.
Okay, thank you. Mike had a question. This is something I'm curious about too. Why do you like commercial retail as opposed to multifamily apartment buildings, mobile home parks, etc.?
Take it for what it's worth, but Warren Buffett's quote always rings true to me while I'm looking for opportunity. When everybody's fearful, be greedy. When everybody's greedy, be fearful. You guys all know COVID threw a wrench in a lot of commercial spaces, a lot of large office, large retail went vacant, right? They were shut down, they were restricted, and people were concerned that it's going to go away. And I see opportunity in that. And whether you agree with me or not, that's fine. It's your cup of tea, your perspective. I choose to want to go into the path where there's less people. I don't really want to say competition wise, but there's just less eyes on opportunity, which gives me the time to analyze it properly and project and to get in a position of having upper hand, right? In my market, multifamily is really high, like insanely high. Not even worth me looking at it from the way I run my numbers. So it was very easy for me to pivot to retail, office, medical, government space, because there was less people looking and there's abundant of opportunity on the market. And it was almost like, why are you guys chasing that fruit tree where there's only at the top? Over here has got all fruit within reach. And I went that direction. And I'm willing to pivot and change. If multifamily changes in the future and it starts to come down to earth and numbers make more sense, I'll go there. But yeah, the office retail, nobody was looking. And I was getting, in my opinion, steals. And my track record recently is it's really progressing towards that buying at a down market and getting ready to exit at the up.
Nice. Sounds like you were able to recognize opportunity and seize it. So really, really good stuff. Raphael asked, and you mentioned 1031 exchange. Could you maybe briefly explain what a 1031 exchange is? And Raphael asked, how was the 1031 exchange experience from residential to commercial?
Easy. I guess if I were to frame it better, I've done 1031s in the past from residential to residential, so it wasn't a big deal. And there's really no difference. It's just larger price point, needing larger equity, easier to identify and displace because you're selling off $100,000, $200,000 homes and you're buying $1 million asset. The identification and the covering of the 1031 is simpler. So with 1031 and do your homework. I'm going to disclose, I am by no means a 1031 intermediary or somebody that you should seek advice from. I'm only speaking from my experience. What you do is you sell an asset that you owned and you're deferring taxes down the road by displacing it into your gains into a newer asset at sale price, if not higher. And you're basically not paying capital gains on the difference of your original purchase price and where the property was sold at. So if I bought it at 50 and I sold at 100, my potential gains is $50,000 and I'm subjected to capital gains tax on that. So instead, I want to throw that 50 that I bought it for and the 50 extra that I have. So now I have 100. I want to throw that into a larger asset. So I'm buying $100,000 asset or larger. And if you're in the commercial space, everything is pretty much mortgageable if the asset is performing well enough and if you have the right lender. So I can take a $200,000 asset and throw it at $1 million purchase. And now I got my down payment just by the sale of a property. So 1031 is just scaling. It's the catapult. It's the greenhouses to hotel concept. Look it up, research it. I highly encourage you to do it. There are some guidelines that discourage a lot of people of doing it. One thing is you got 45 days to identify. You identify up to 3 properties. And if not, there's some mathematical equation for going beyond that. And I don't even like thinking about it because I'm not the smartest guy. I like to keep it simple. Find 3, close on one of those 3. You identify in 45 days, you close in 180, you don't pay gains. There are creative ways to do reverse 1031s. There are creative ways to do 1031 purchase first and then sale of the asset you're rolling into after, but that's all minutia. You can go and talk to a 1031 expert and they can give you the breakdown of different variations. For me, love 1031. I have a specific strategy I follow, and I haven't had the opportunity to miss a 1031 yet.
A question that I have is, are you able to purchase a commercial property in your personal name, whether you're purchasing it or doing a 1031?
It depends. It depends on where the asset is, and this is more of a legal / accountant CPA type of a question. So again, disclosure, check with your professionals. Don't take my word for gold. You can and you can't, and it all depends on so many things. So like a situation would be is if you had an asset and you're married, but you had it in your husband and wife's name here in Hawaii, which we ran across personally. Me and my wife owned our old house here, and it turned into a rental because we didn't know any better. And this is pre-learning real estate. But we owned it in our personal names, and we were selling that to 1031 into an asset up there. It turned out to be a commercial, and we didn't know that our entity, LLC, most commercials you buy in LLC, this is where you want to seek legal because it's very confusing. Once you create your LLC, the entity that's going to own it and the lender is going to lend to it We made the mistake of making it a sole owner LLC. Basically, my wife was the owner of that, but we were both on title. So then it got all crazy messed up. We had to amend this and then this. Well, ultimately we had to close. So we closed in personal name and then we wrote it into our newly formed entity where both of us were partners. And that's just an example. Very rare that you're going to be able to buy in your personal name. In my experience, every lender I've spoken to required it to be in a LLC.
Okay, good stuff. And like CJ said, right, everything that we're talking about tonight, very general information. If you want specific information, go and seek professional advice from your tax advisor or legal counsel. Yeah. All right. So Ellard asked, is there a difference in dealing with residential tenants versus commercial tenants?
Good question, Ellard. Yes. So remember the part of my wife being exhausted and tired? Well, 90 doors is a lot of properties. That's 90 leases. That's 90 tenants. That's 90 toilets plus probably double. But she was basically on the phone with a PM, or one of our multiple PMs, maybe every other day, handling a situation, whether it's eviction, a deferred maintenance, a capital expenditure, a lease renewal, a month-to-month situation where we're kind of contemplating on what we want to do. She was consistently on calls and it was exhausting. What we've pivoted to in the office, retail, medical, government space, it allows us to operate with tenants that have extended leases. And in certain situations, if you guys understand commercial leases, there's full service gross, which is basically the tenant pays a base rent like a residential, and you operate like a residential where you're obligated for all expenses, taxes, insurance, upkeep, and so forth. Then there's modified gross where tenants responsible for variation depending on how you structure it. And there's triple net. Triple net is where we tend to float in, where our tenants are responsible for everything outside of our debt service. It's been the most relieving thing for my wife to not have to overly process and monitor our assets because the tenant's obligated for it per lease. Plus, our average lease is 5 years. So if they're taking care of everything, which they're obligated to, it's in the contract, they're paying for taxes, insurance, upkeep, common area maintenance, yin yang, whatever you want to say, and we're only making our mortgage payment. Everything outside of that mortgage payment is pure cash flow. And we have the peace of mind knowing that in 5 years, they're still going to be paying up to that point. Yes, we do run vacancies because no different than residential, businesses can go out of business. And it's happened, and we need to be prepared for it. They're less likely because we feel that we identified proper tenants. Knock on wood, we haven't had anybody that had to close down even during COVID. If anything, they produced more. We feel we identified with our teams good tenant base that can withstand lows in the market. So yes, I love commercial tenants. I'm not saying I don't love residential tenants because when they pay and they're good and they take care of their property, they're great. It's the ones that are problematic. It's the ones that don't want to pay because it's COVID and, well, I'm not working, so you shouldn't get paid, but the bank's coming after me. So that whole 9 yards. We did not experience that in the commercial realm. We experienced a lot more of that on the residential side, which just motivated us to carry more of our properties over to commercial.
Cool. All right. Now I know as far as, acquiring these commercial assets, you talked about using 1031 exchange and so forth. Tom asks, and if you can add on to it, Tom asks, did you use your own capital for your commercial deals or did you use private money, hard money, syndications, etc.?
Good. For the first deal was purely 1031. We were able to position ourselves well where all of our assets were debt free by the time we started looking at commercial. So 90 doors free and clear. It was a lot of work, a lot of sacrifice, a lot of discipline, but we were able to put ourselves in a good position and the market just kept rising. So it gave us a lot of buying power for an asset that we bought really low. So initially, a lot of it was offload 1031. And then we got creative because I want to always test my boundaries. Back to Robert saying to me, right? Get comfortable being uncomfortable. I wanted to see what I was capable of doing. I have purchased commercial with 100% private money. I have purchased commercial with creative financing and seller carrybacks. And what I found, as much as they talk about residential being able to do like subject to and seller financing, I've been able to do a lot more in the commercial space than I have in residential. And my belief is this: you're dealing with entrepreneur, business, investor-minded people, right? Single family homes, you have a lot of homeowners or people who have inherited property that may not come from the investor mindset. So they don't speak the same language and may not understand what your concept is when you're really genuinely trying to solve their problem. And sometimes it doesn't work with a traditional finance way. In the commercial space, that's what they expect. I have counters to my traditional offers of a 20, 25% down in mortgage with a lender with, hey, I'll carry the entire debt for you at XYZ terms and rates. And if you pay me back here, this produces this cash flow. Are you interested? Oh yeah, I'm always interested. So we've been able to cultivate different strategies in the commercial space in a more aggressive way, meaning higher success than I ever was in residential. And I've done seller financing, I've done lease option to buy, I've done all these other variations in residential. But it was extremely challenging because I was dealing with the emotional side of a person, primarily because they were the homeowner. That was their home. And they got attached to it. And I don't blame them for feeling like I'm messing with them or screwing them over when I'm genuinely not. I'm trying to solve your problem and prevent foreclosure. So yeah, commercial allows me a lot more freedom. And I've done many variations of purchases through whatever you can think of minus hard money. I've yet to need to use hard money.
Cool. Okay, good stuff. Now going back to teams, Kamohai and Tristan asked, are the teams you have built for commercial similar to that of the single family residential side? Who are the integral members on your commercial team?
I mean, they talk about the core four in the residential, right? So you got your lender, your agent, your property manager, and your contractor. That's pretty much your base for your residential. A lot of that can carry over, but I feel your team needs to grow. So you're gonna want, I'm gonna rephrase that. What I look for is people who are laser focused and skilled in one specific thing. And I want to work with that. I don't want to work with a jack of all trades. There's nothing against being a jack of all trades. I feel it's hard for me to focus you in on the important task at hand when you can do multiple things. I don't want multiple things. I want an expert in one thing, and then I'll build experts in all the other areas I need to focus all in on this one opportunity. So you have your agents, that's a must. The commercial agent operates very differently than a residential. And in my experience, I've had more issues finding solid commercial agents than I did residential agents. You have residential agents that think they can transition over into commercial, but they know nothing about what is required to do your due diligence in commercial. Lenders are different. You operate with different lenders. You operate with different property managers. Same, I guess, shell of a position, but you're looking for skill sets in commercial specific. You have different insurance providers, you have different contractors, you have different legal. I mean, legal is big in commercial because you're talking these huge corporate leases sometimes, right? So like one of ours, we have Pizza Hut, we have a Subway, we have these larger corporate backed leases, and they have high caliber legal. Well, we're negotiating with their legal team. So if my legal team can't go to bat with them, I'm at a disadvantage when I get to the table. So for me, a lot of our leverage comes from a very solid commercial property manager with a backing of a very good legal counsel. That helps us to structure our contracts properly where it's good for both parties. And then you got your one-offs, you have your subs here and there. So for one thing, I love our roofer that we have because I don't know about you guys, but a roof on a commercial building, I didn't know this, ain't cheap, right? So in our market, an average roof replacement down to, the plywood and whatever, it's probably about 13, 15 grand for a single family home. I got quoted for one of my commercials that is 30,000 square feet, $750,000. And that's just to go over, not replace down to the roof. If I wanted the roof replacement, it was something like 1.7 mil. And that's just the roof. So certain subs are crucial in being able to have them on your team because they give you leverage to negotiate. How many investors actually go on their roof, right? We just had torrential downpour in our market, and I'm about to enter in contract. And one of the properties I had my team walk, and I'm in the process of working out the contract. Well, my roofer went out because he's like, you know what, CJ, I got to go and check. I want to make sure. I was a little concerned with the roof, but now that we got the 6 inches of rain, I want to go make sure. Well, he went up there. One little pinhole caused a 10 by 10, so 100 square feet of damage on the roof. One little quarter size hookah in the roof caused that much damage. What was going to be $500 to patch when it was dry because of the torrential rain and the water that got underneath it is going to require $30,000 to repair. That's huge. About to go into contract on a commercial asset. So now I'm back at the negotiation table like, hey guys, unfortunately, this just happened and I'm not going into contract until this is remedied or we can come to a solution where I'm willing to take on the risk. So team members, come on interest in, you're going to probably have double, if not triple of what you would probably need in a residential space. Just put it that way.
Well, that's a pretty large bill for a roof. Okay. So Alan asked, do you prefer triple net? And if so, how do you restructure existing leases?
Oh, good question. Loaded question. I love triple net. It does produce less cash flow on the net side because of the risk that goes to your tenant. You don't get a larger return. You get the peace of mind, right? So when I see a triple net, I'm looking for the peace of mind of not having to be on the property like I was or my wife was with the 90 doors. It gives me that peace of mind. Restructuring, it's no different than residential. If there's a pre-existing lease in place, you have to honor it, right? You're going to assume it, you're going to honor it, you're going to see it through. And when you get to that period, whatever that may look like, and here's where the legal really comes into play in a good property manager is commercial leases are not dime a dozen. You know, most residentials is pretty straightforward, right? Your monthly rent, year long, 12 months, XYZ expenses are deferred to your landlord, but you're obligated for utilities and trash removal, yard upkeep, blah, blah, blah. You got that simple cookie cutter lease. In commercial, every tenant could be a different lease. I think the longest lease my wife read, because I don't like reading books, was like 120-page corporate lease. And it took her about 3 weeks to get through it, to understand the verbiage, and then to ask questions to have it modified because certain things were incorrect. Meaning the person who actually wrote it wrong too. And her and our legal team were able to find the mistakes, which actually benefited us. We found out that the tenant was obligated to pay taxes and insurance, hence having a triple net, but they weren't. They were operating as a modified gross where the landlord, the owner, was still paying taxes and insurance. But we found that little loophole and we were able to kick it back at them without any rebuttal because there was an error in the wording. So in occasions like that, you can catch that and modify the lease there or acknowledge that the tenant's not fulfilling their obligation and pursue reimbursement of when you take ownership. But for the most part, you honor leases just like you do in residential. I tend to restructure when the lease gives me permission. The very next day, I'm at the table, or me and my wife are at the table talking about how can we extend, how can we keep you here, how can we start to deflect some operating expenses, hence looking to create more of a triple net setup than full service gross lease. Does that answer his question? Good.
Yeah, I believe
Yep,
so.
got it. Thanks.
Perfect.
Right on. Thank you, Alan. Thank you, CJ. I guess to piggyback off of that, I mean, besides dealing with the leases, are there any other ways to increase NOI when the property is already fully leased, or at least close, you know, the 80 to 90% occupancy, like you said?
Value adding is a lot of it comes from the leases and the vacancies you can fill. I guess reading contracts like that example is probably your best case scenario when you're buying an occupied space, is you're looking for errors in. We buy, some of our price points we're buying in are mom and pop investors that were residential and then bought one commercial, and that one commercial satisfies their cash flow because they're in that market, and that one commercial puts them at retirement, right? But they never ever grow beyond that. And they're literally legal pad style P&Ls, profits and losses, where they're writing everything by hand. Everything has been note taking. They actually keep their paper receipts, and we have to sift through that. And we find most often than not that they're not accounting for certain things. That example of the owner not needing to pay taxes and insurance wasn't a smaller investor type mom and pop investor who owns 2 buildings, right? And they just didn't know their lease because it was 120 pages. They never even read it. They just signed it and then assumed the cash flow was their cash flow, and they never thought otherwise. They never had anybody verify. So things like that surface a lot more in your due diligence phase in commercial, which gives you that opportunity to see value, or it can always go against you too. It goes both ways, right? It cuts both ways. So sometimes you read into it, and the tenant in one situation was under contract for a lease for a larger square footage space, but they weren't. And they were paying for a larger square footage space, but they were really occupying half. So that rental agreement is not binding. They're not getting that other half because that other half was rented to somebody else. So you can't double charge for a space to 2 different people when only one can occupy it, right? So in that sense, our NOI dropped when we were assessing the asset. The income dropped because this person wasn't paying $1,000. They were only obligated to pay $500. But the owner wasn't aware that the lease had that. And during due diligence, we mentioned it, and all of a sudden the crap show happened because the tenant was irate that they were paying for X amount of years over for a space they never used while that space was performing already. So it opened up a whole can of worms, and we just sat back with our popcorn and waiting for them to reduce their price. Unfortunately, that deal didn't work out. The owner just kept the asset and dealt with it himself.
Oh, okay. So yeah, good to read the leases. All right.
Yes, leases is where value add is at.
Okay, awesome. Thank you. As we come up to our time, I wanted to see if Gilbert, hey, did you have any comments or questions you had on your end?
Sure. Really quick, I had so I'm a numbers guy, right? So learning from as CJ mentioned earlier, single family, right? You start at a single family, you learn how to you run your numbers, you get proficient at it. My question is it similar in the commercial world? Running numbers. You talk about NOI a lot, so when I hear NOI, I hear cash flow. In the buy and hold world, cash flow is that's what we live for, right?
Right. Commercial, completely different the way you assess the asset. At least how I run my numbers is, I would think it's pretty standard across the board, is you're going to work with a cap rate, and that's the valuation measure based off of performance for the asset, and whatever the market determines a cap rate to be will then be the evaluation or the equation you use to figure out how much the asset is worth. Unlike residential is market driven, right? So you got your ARVs, after repair value. If the market is hot, like it is in Hawaii, and your median house price is over $1 million, well, that's your comps, your ARV numbers you can run with if it's like kind. In commercial, you can have 2 buildings next to each other, same square footage, same build, same everything. One's occupied 100%, the other's 50%. Well, this one that's occupied 100% might be worth $1 million based off of its performance. The one that's 50% occupied could be worth way more just because the NOI is larger, which doesn't make sense, right? 100% occupied versus 50, but it comes down to lease structure. It comes down to your actual NOI, your net operating income that you take prior to debt service, right? So what people confuse often is they'll account for debt service in the NOI, not including debt service in your evaluation of the asset. So residential, comps, ARV, market driven, commercial is purely asset driven. So subject property and its performance matters. You can't just take two buildings and say they look alike. So this one's worth $1 million and this one's worth $1 million just because they're the same. You got to do your evaluation. I like commercial because it's purely a numbers thing. It's just simple math. Math doesn't lie. You either are right or you're wrong. And that's a lot of my negotiation play is simply using the seller's information and altering what I perceive the cap rate to be, right? So if we were to throw out something that you guys might be able to understand, I think the nationwide cap rate in 2021 for commercial spaces was like 6.6%. 6.6% is a solid producing asset, something like a CVS, a Walmart, a Chick-fil-A. I like Chick-fil-A, but that might be your 6.6% cap rate with a corporate back lease, 10 plus years. I've seen leases 50 years out. That would be your 6.6, if not lower. What I'm buying value add wise, I tend to buy above an 8% cap rate. And people confuse the cap rates. The higher the cap rate, they think it's the asset's worth more. No, the cap rate, the higher the cap rate, the worse performing the asset is. The lower the cap rate, the more stable it is. So my goal is to buy something between an 8 to 10% and bring it down to a 6. And if you do a math on an NOI, when you do a 10 cap purchase versus a 6 cap purchase, you'll see the evaluation change just off of math. And it's something you can toy with, right? So you take an NOI, you divide it by 10%. That's your purchase price. You take the same NOI, you divide it by 6%. That's your evaluation when it's fully performing. And that's how you get the value add in commercial, by just changing the cap rate and or your NOI, or both. Does that answer your question, Gilbert? Okay.
Right on. Okay, so I know we're coming up on top of the hour. We had another question. We're going out to do breakout rooms really shortly. And that's where we can discuss and network with other investors. But for CJ, you know, if I'm interested in getting into commercial real estate, right? Do you have maybe one piece of advice or one resource you can direct that person to, just to kind of get more information about commercial investing?
I think our biggest help was networking and speaking with commercial investors directly and getting a feel for what we wanted to magnetize and gravitate to. However, we did focus. So follow one course until successful. Focus. I picked a lane and I stuck with it. So yeah, it's retail, office, medical, government, but they're basically office buildings with different tenant base. That's what I focus in on. I don't do mobile home. I don't do senior living. I don't do large multifamily or apartment complexes. I do this, and I focus in on this because what I believe a lot of our success comes from is our commitment to being successful and great at a single strategy. And that's what's carried us here. And it's what's going to carry us in the future. And I kick away opportunity in other areas that do not support my focus. So network with other investors, pick their brains, ask them questions. And if something catches you, run with it. Run with it until you see it through and you're successful at it.
All right, good stuff. And I really like that. Yeah, focus. Good stuff. Okay. So CJ, thank you. Thank you for just sharing with us tonight some things that stood out to me, right? Getting uncomfortable. Just that quote from Robert Kiyosaki, you have to get uncomfortable or get comfortable being uncomfortable rather. And then just you seizing opportunity, right? Buying that retail space when most people are kind of running away from it. I think it takes a lot of guts. And yeah, just congratulations to you guys on that. Is there a place where people can get connected with you if they wanted to get connected with you, or even with WNN? Where can we find you at?
Facebook, Instagram at WNN Properties. And if you guys wanted to pop it in the chat, it's WNNproperties.com. That's our website, has a little bit more info. We have services that can assist newer investors who are looking to just get started. We do have only a residential platform at the moment. I am creating a commercial. Real quick, we are believers in we go first. So we need to prove and have that concept locked down before we take anybody with us. So we're not one of those that be like, hey, Brandon, you go try commercial, let me know how it goes, and I'll learn from your mistakes. We put our money where our mouth is. We go first. It's what we did in residential. It's what we do in commercial. We will be developing a commercial platform soon. I'm looking to have that launch in 2023.
Right on, exciting stuff. Okay, well, thank you again, CJ. Thank you for your time and coming on to Westside Meetup. We are not done yet, so don't go away. We are going to be going into breakout rooms in a short moment. We're just going to be completing our recorded part of the meetup. Before we do that, as we get our breakout rooms set up, I just want to share some upcoming events that are going to be happening in the next couple weeks or so. On April 9th, we have a real estate at the park meetup. So that's for out-of-state investors. If you're interested in investing out of state, or if you're looking to learn more about what it's all about, you can come out. We're going to be meeting in Salt Lake, not at Salt Lake District Park because they already have something going on April 9th, but we're going to be meeting in Alyamanu Neighborhood Park. I think they also call it Connie Chun Neighborhood Park. But anyway, look out for that on social media, and in the email, we're going to be blasting that out to you folks as well. And then we have Full Real event. This is happening on April 13th. And that one, I'm not too sure actually if there's any availability. Gilbert, are there still slots available?
There is. There's several more. They're selling out quick. So if you're wanting to come to the For Real event in Kapolei, I suggest you get your tickets soon. Look out for it on Westside Meetup. The Facebook group there, we'll try to share it with everyone.
Cool. Yeah. So good. That's happening on April 13th. It's a Wednesday. So make sure you go get your tickets before. How are we looking for breakout rooms? Are we ready to go? Cool. Okay, so now we're going to be transitioning into breakout rooms. And this is just an opportunity for you folks just to get to meet each other. And this is primarily because, when we had COVID and everything, it was hard to meet each other face to face. But yeah, we were here on Zoom, and we're going to be going out into smaller groups of 4 to 6 people. And in those groups, I want to ask you guys to share, number one, who you are. Number two, what you do in real estate. And since we're talking about commercial real estate tonight, I want to ask you guys to share, if you are investing in real estate already, are you going to be moving into commercial real estate, or are you already investing in commercial real estate, and how's that going for you? Okay, so those 3 things, it's going to be, no problem, Katie. So it's going to be those 3 things that I'm going to ask you guys to talk about. We're going to be in there for the next 25 minutes. Then we're going to come back into the main group and share whatever else needs to be shared, some upcoming announcements. And yeah, so I will see you guys in 25 minutes.